Moving average crossover strategy has stood the test of time. Really, this strategy has been working for hundreds of years. I think AQR Hedgefund did a study where they found that trend following strategy has been working for the past 800 years. I mean, don't quote me on that, but it's definitely more than 100 years. I didn't know anything about trend following strategies. And in fact, I paid for a seminar for a trend following strategy without knowing that it is a trend following strategy. This was like 20 years ago. I paid $2,500, which is like $2.5 million after inflation in today's money. But anyway, I attended with about maybe 50 people. And basically, he showed us how the 21-day moving average cross over the 53-day moving average. We go long, and then the opposite, we go short. So that was my intro to trend following, and I dumped good money behind that strategy, which of course lost a lot of money and got wiped out. I really got to know trend following strategies when a fund manager introduced me to a book. The book is Complete Turtle Trader by Michael Covell. Really, this book opened my eyes about algo trading and especially trend following strategies. About a year later, I was introduced to another book that really took it to the next step. This book basically takes the public results by the hedge funds, the trend following hedge funds, and he builds systems that try to mimic the returns of those funds without knowing the rules. So basically he builds like moving average crossover system, and he tried to find out what period they are using and apply it on the same universe that they are trading, and basically come up with the same average returns that they are showing per year. So in this video, I will take one of the systems that he built in this book, which is the moving average crossover, and we will trade that on a currency pair. So here we have a currency pair, which is the US dollar, Japanese yen. And this is a very trendy currency pair. And I plotted here two exponential moving averages. So we can see the periods here, it's 30 and 60. So basically, we want to go long when the 30 cross over the 60, and we will go short when 30 cross below the 60. So here we are, and this is the JY future. So basically, this is the Japanese yen over the US dollar. So it's the opposite of the USD JPY. And I applied the strategy of the moving average crossover. So whenever the short-term moving average cross above the long-term, we go long, and the opposite, we go short. So we are always in the market. And this is the 30 over 60. It's an ugly equity curve. I don't like this. But anyway, let's see. We have 62 trades split right in the middle. This is for the past 17 years. Now we can easily optimize this. So here I will optimize the fast length from 20 to 100 and the slow length from 40 to 200 in step of 10. So overall we have 153 combinations, and here are the results sorted by return to drawdown ratio. So at the top here we have 40 and 170. So when the 40 fast moving average cross above the 170, we go long, and when it's below it, we go short. That produce even lower trades. So it's 31 trades now, but on average, we're making 1,519. If we want more trades, then this is 90 trades, which is 20 over 40. But we make much less money because our average trade now goes to 330. So we will introduce two rules in order to make this a proper system that hedge funds use to trade their funds. So first rule we will introduce is the highest high and lowest low. So here I plotted the highest high with a look back period of 50. This means that this line will always be plotting the highest high of the past 50 bars. So rule number one that we will add, that once the crossover happen, we need to wait for the high to cross the highest high. So that means when we have something like this. So in this case, you see this one. So when this one happened, that means this high crossed over the highest high. So that's rule number one. The crossover happened, and we have the high crossing over the previous highest high. The second rule we will add is a trailing stop. So this trailing stop is based on ATR. So for example, if we enter at this bar here, we will exit over here because over here the price closed below this trailing stop. And if it happens here, that means we will enter again at this highest high, and then we will exit at this bar when the price closed below this ATR. Let me switch off the moving averages so you can easily see it. So remember, the moving average here is correct, meaning the fast above the slow, and then we enter here at the highest high, and then we exit here. So as you can see, this ATR stop loss will decide how long you stay in the trade. So for example, if I increase this ATR to 6, you can see that once we entered here, we are still in the trade until this bar. Those two rules will play a big role in enhancing this strategy because basically we are filtering the trend. So once the crossover happens, we are waiting for a confirmation, which is the high to break the previous highest high. And we will exit faster than when the moving average cross below, because now we're exiting within a trailing stop, which is faster than the moving average, the fast moving average crossing below the moving average. So now we can optimize the strategy with these parameters. So first we have the entry look back. That means how far we are looking for the highest high and the lowest low. So we will optimize this from 10 to 70, step 10. The ATR length, I'm going to keep it fixed at 20. Of course, you can optimize that. And then the multiplier from 1 to 5, step 1. And then I will also optimize the fast length and the slow length the same as we did before. So overall, we have 5,355 strategies. And here are the results sorted by return to drawdown. We can see here, this strategy is much better. It's making $77,000 almost with about $27,000 drawdown. The average trade is 1069. And this strategy is using 60 period for the fast exponential moving average and 180 period for the slow exponential moving average. And the ATR is, of course, 20, the look back. The multiplier is 4. This is for the stop loss. And then the highest high and the lowest low that we are using to enter short and long is 10. Now, the strategy right below it has 251 trades, which is much better because I'm sure that I can add a filter for volatility or direction to get this to a better average trade. But let me use this for the example. So here are the results of this strategy. We have 72 trades, 28 long, 44 short, and very good average trade for both. So the short is doing much better at about $1,200 and the long about $880. Now about 40% win rate, which is very good for a trend following strategy. In fact, the short side is doing really well, which is 52%. Now all hedge funds use a big universe to trade the strategy. So they apply the strategy to, let's say, all currencies in this case. And they apply it to agriculture and indexes and so on and so forth. So they usually trade like at least 50 markets using the same strategy and some variations of the strategy. They don't trade it on a single market because it's hard to find a lot of trends on a single market every single year. But they also use position sizing to enhance their returns when they find a trend. So I will show you a simple method for position sizing. This is one of the simplest, which is basically restrict the strategy to use a fixed position based on the volatility. So at the bottom here, I have the ATR indicator in dollars. So what this is showing is the amount in dollars that Japanese yen futures move in a day. So for example, at this entry, the short entry, the average ATR in dollars was $1,142.50. So I will introduce another variable that will restrict our position sizing based on this volatility. So this is the variable. Let's start with 2,500. So basically, I want my strategy to build a position that should move on average $2,500 up or down in any given day. So going back to our example here, we can see we are shorting 2 contracts. So we bring our calculator. Let's see how we get there. So at this point in time, before we took this position, the day before, our ATR was 1057.50 and our risk is 2500. So 2500 divided by 1057.50, we get 2.36. And since we cannot trade fraction futures, at least for now, so we take the decimal. So in this case, it's 2. So that's why we are trading 2. Now, what does this mean? This means that in any given day after I take this position, on average, I should move within $2,500 range. So that means I should go up 2,500 or go down 2,500. So I'm limiting my portfolio to move up and down by 2,500. Now, remember, this is a moving target. Now, we can take another example. Let's see this one. So this one is short 4. So at this point in time, this is the entry. So the day before, our ATR in dollars is 545. So again, we divide 2,500, which is the variable that we assigned, divided by 545. We get 4.58. Again, we take the decimal, which is 4. And that's why we have 4 contracts. Like I said, this is very simple algorithm for position sizing, because let's say you start 10 years ago with $100,000 and you are using $2,500 for your algo to position size. And now let's say you have $500,000, but you're still using 2,500. So you're not using the full potential of your capital. Still, that is one method of position sizing. It's very simple. You can easily explain it and follow it. But let's see the results of this simple position sizing. So I'll keep all the values the same. So the highest high, lowest low is 10. The ATR length is 20 and the multiplier is 4. And then the fast average is 60 and the slow average is 180. We're only going to play with how many contracts we buy based on the dollar average true range. So we'll start from 0 to 10,000. In a step of 1,000. So that's only 11. And here are the results sorted by the risk metric. So 0 is our original strategy. So we're always trading one contract. Remember, we made $76,000, 2.83 return to drawdown, 72 trades. Now we are not changing the trade. So that's why you see all of them 72. We are only increasing the number of contracts we are trading in the same trade. So at 10,000 risk, meaning we are allowing the strategy to go up and down by $10,000, we make $678,000. And we don't suffer a lot in return to drawdown. This looks really good. So at $5, the risk metric, we are about 257 return to drawdown ratio, but we are making really a lot of money. So instead of 76, we are making 332. But our drawdown now is 129. So let's pick this strategy. So the curves looks like the same. And let's see the list of trades. So you see now the contracts is changing. So 7, 4, 5, 3, 1, 2, and 3, and 4. So we are definitely trading different number of contracts based on the volatility. Now, what if we add the risk variable in the optimization? So that will increase the total optimization to about 60,000. And here are the results sorted by return to drawdown. And the first result is almost double the previous strategy. So the previous strategy was about 2.8 in return to drawdown, and this one is 5. So it's not the highest net profit. So we can sort by highest net profit. We have 800,000, but return to drawdown is much better. So at 5. And this is the risk is 8,000. And the fast length is 70, slow length is 50, which is, you might think it's odd, but really because the JY is the opposite of the USD JPY. And the USD JPY usually go long more than it go short. In any case, these are the settings. And then the ATR multiplier is 3. And then the highest high and the lowest low is 60. And this is how the strategy looks like. So 515. With 5 point something for return to drawdown. And now the curve is much better, but the number of trades is 25. So strategy number 85 is the first one that has more than 30 trades. So this is 50 trades, but it's still better return to drawdown. And these are the settings. So 4,000 for the risk metric. And then the fast moving average is 30, slow moving average is 40. with 5 ATR multiplier and 50 for the highest high and the lowest low. This is how the strategy looks like, and these are the results. So 22 long, 28 short, both of them of course making really big average trade, because remember we have position sizing on. Now remember, you cannot trade this strategy or any trend following strategy on a single instrument. You will eventually wipe out your account, or you will get bored and quit it, because you will not find trends. You need to trade it on multiple markets, and you need to trade multiple iterations. So just like I showed you, like the 30 and 60, the 40 and 50, and so on and so forth. You need to have multiple. So you need a lot of capital to trade moving average crossover. I mean, the strategy works, but you need a lot of capital. And that's why it's only reserved for hedge funds or family offices, or somebody with a lot of capital, let's say, $1 million, because then you can divide the $1 million on multiple strategies, multiple instruments, and you can get a really good portfolio. If you like this video, then you will love this one.